Now we will see CBSE Class 12 Economics Chapter 5 Government Budget and Economy Revision Notes. Budget is a financial statement showing the expected receipt and expenditure of the government for the coming fiscal and or financial years. Main objectives of budgets are reallocation of resources, redistribution of income and wealth, economic stability, management of public enterprises, economic growth, generation of employment. There are two components of budget: revenue budget and capital budget. Revenue budget consists of revenue receipts of government and expenditures made from such revenue. Capital budget consists of capital receipts and capital expenditure. Budget receipts: 1. Revenue receipts: tax, direct tax, income tax, corporate tax, wealth and property tax. B. Indirect tax: on that, value added tax, service tax, excise duty, custom duty, entertainment tax. B. Non-tax: commercial revenue, interest, dividend, profits, external grants, administrative revenues, fees, license fee, fines, penalties, cash grants in aid from foreign countries and international organizations. Capital receipts: borrowing and other liabilities, recovery of loans, other receipts, disinvestment. Direct tax: a direct tax is one whose burden cannot be shifted to others, that is, the impact of and the incidence of the tax is on the same person. Example: income tax, wealth tax, gift tax. Indirect tax: indirect tax and is one whose burden can be shifted to others, or the impact and the incidence of an indirect tax falls on different people. Example: excise duty, VAT, service tax. Revenue receipts: neither creates liabilities for government nor causes any reduction in assets. Capital receipts: it creates liabilities or it reduces financial assets. Budget expenditure: neither creates assets nor reduces liabilities. Example: interest payment, subsidies, etc. Capital expenditure: it creates assets, it reduces liabilities. Example: construction of school building, repayment of loans, etc. Budget deficit: it refers to a situation when budget expenditure of government are greater than the government receipts. Budget deficit: to expenditure greater than total receipts. Revenue deficit: it is the excess of government revenue expenditure over revenue receipts. Revenue deficit: total revenue expenditure greater than total revenue receipts. Implications of revenue deficits are: a high revenue deficit shows fiscal indiscipline. It shows wasteful expenditures of government on administration. It implies that government is dissaving, that is, government is using up savings of other sectors of the economy to finance its consumption expenditure. It reduces the assets of the government due to disinvestment. A high revenue deficit gives a warning signal to the government to either curtail its expenditure or increase its revenue. Fiscal deficit. When total expenditure exceeds total receipts, excluding borrowing. Fiscal deficit. Total expenditures greater than total receipts, excluding borrowing. Implication of fiscal deficit are it leads to inflationary pressures. A country has to face debt trap. It reduces figure growth and development. It increases liability of the government. It increases foreign dependence. Primary deficit by deducting interest payment from fiscal deficit, we get primary deficit. Primary deficit, fiscal deficit, interest payments. Implication of primary deficits are it indicates how much of the government borrowings are going to meet expenses other than the interest payments. Measures to correct different deficits. Monetary expansion or deficit financing. Borrowing from public, disinvestment, borrowing from international monetary institution and other countries. Lowering government expenditure, increasing government revenue. Thank you.